Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. This week, we are going to put the spotlight on investing in global equity markets via global funds, or you can call them international funds. Now, mind you, these are funds that are being run by Indian asset managers. So why do you need to look at these funds in the first place for your portfolio? What is their taxation structure? And what funds could perhaps be suitable for investors given the risk appetite and the risk-taking ability? Well, this is what we talk about, and to help us demystify this world of international investing, we have with us Nasser Salim of Flexi Capital and Niranjan Avasthi of Edelweiss Mutual Fund. Gentlemen, great to have both of you on the show. Thank you so much for joining in. And I thought perhaps it's an apt time, right? Because I don't think we've seen so much of volatility in the Indian market, in the international market. The headlines are changing by the minute. And you realize that perhaps for an involved investor, it might make sense to have some exposure to shores that go beyond India as well. So let's get your opening thoughts. And Niranjan, you folks at Edelweiss have so many of these global funds, from China to US tech to I think even Europe, right?
Yeah.
Why should one go global?
Yeah. First of all, thanks, Surabhi, for having me. Broadly, over the last 2-3 years, we have seen huge traction for investing globally. And, especially in last 1 or 2 years, when we have seen global markets, Indian markets going through volatile times, it is very, very important to study this category and take exposure. 2-3 reasons, One, if you see last 10 years, India has been amongst the top 3 performing markets, maybe 3 to 4 times. US has been there 6 times and China has been 2 times. Now, if you want these winning markets to be in your portfolio, you need to invest beyond India. And if you have them, it's basically easier to navigate, cycles in the market. The second is, if you see India as a market cap, contributes maybe 3 to 4% in the MSCI World Index. It's broadly 3-4%. US, on the other hand, is roughly around 65 to 70%. China is around 14-18%. Now, if you look at a portfolio, you can't ignore a large cap in your portfolio, right? From a market perspective, these are large cap names, or these are large cap nations out there which you need to have in your portfolio. Second, if you see the top 100 market cap companies in the world, 50 plus are from US. Only 2 are from India, and maybe 16 are from China. Now, again, you can't ignore these, heavyweights, big global companies. And for all these, you need to invest globally. Last, but very important, you need to build some dollar assets. If you see our INR against dollar over the last 30 years, it has depreciated every year by 3 to 4%. In last 10 years, US S&P 500, if you see, has given somewhere around 12.75% returns, whereas in INR terms, it has given 16%. So 3.25% return just adding up just because of INR depreciation.
Yeah,
so these 3 are very, very important reason why you should have some exposure to global.
Oh, I can't argue against any of those 3 points. They seem perfectly logical, actually. Let me ask Nasser as well. Nasser, your thoughts. And the thing is that now that everybody has access to information, typically it ends up being a bit of fad investing. When the NASDAQ is going up, you see people want to invest in NASDAQ and they want to invest in NVIDIA. When suddenly there is a boom in China or some stimulus in China, everybody starts talking about China. But there has to be better reason and scientific logic behind looking at global funds, right? What would you say?
Good morning. Thank you once again for having me back on your show, Surabhi. Always a pleasure. So, great question again there. I think, there are multiple reasons why global funds need to be part of your portfolio. And I think it stems from the very fact that, the decision starting from the basics of core and satellite, I think that is something which, is one of the main constructs and the reasons for one holding global funds. But I think broadly 4 broad reasons, So the number 1 is geographical diversification. I think, lowers dependency on India-specific macro cycles, politics and weather-linked risks. So that's one major reason. The other one is access to sectors absent in India. For example, very thin that are only available in India. World-class tech platforms, you've seen Fangs of the world, semiconductor majors, global healthcare, innovators, luxury brands would be. Some of these are not available in India to Indian investors. Third, I think, one of the very important factors, while, index and indices keep changing, I think currency hedge is a very, very important factor which needs to be kind of factored in. The INR has depreciated over 3 to 4% per annum versus the USD. over the last decade or so. Foreign assets priced in USD act as a natural hedge survey for long-term rupee obligations, such as overseas education for children, for example. Then there is the entire valuation and cycle, which you just mentioned. US-China bear phases often coincide with rich valuations at home. And owning both of those markets kind of smooth the ride. And our view is that, for example, the 2025 market note recommends that one should, in current times when we spoke about, at least 10 to 15% allocation should be to international funds for precisely these main reasons.
Oh, okay. So 10 to 15% allocation, that's fairly sizable that Nasser is talking about. But Niranjan, let me ask you the same question. We want to do this scientifically for long-term wealth creation, right? In and out, timing the market, knowing that, okay, China is bouncing in next 3 months, China will do better than India, and then buying a fund, getting out of it. That I think requires some next level rocket science, market predicting ability.
Yeah.
Now, we don't want to talk about that because not everybody might have that.
True.
Then how can you benefit? And over longer periods, what is the kind of wealth generation that these international funds have given investors?
Right. So broadly, it should be satellite portion of your portfolio, but this satellite portion also needs to be invested in a strategic way, right? Now, Nasir mentioned that 5 to 10% or maybe 10 to 20%, depending on which way you are looking at your portfolio.
Yeah.
For most beginners, maybe 5 to 10% is a good starter to get into these funds.
Okay.
Strategically, if you want to invest structurally, what you need to see is 3 things. One is go for countries which complements India, which are large. Like US definitely is one country where you cannot ignore to have in your portfolio. It's growing, most innovative companies are coming from US. The market size is huge. That is one. Second is also look for a region, if at all, which again has maybe lower correlation with India.
Okay.
Again, US comes up first because it has probably 0.3, 0.25 correlation with Indian markets, which means when Indian markets aren't doing well, probably US markets along with currency depreciation will add to your portfolios and improve your risk adjusted returns. So strategically select these kind of countries, go for plain vanilla index funds or diversified funds in these countries, and go for maybe SIP and long-term allocation. There are people who want to do it tactically, as you mentioned, forget about US or China. Even in India, it's very difficult to tactically get in and get out.
Yeah.
But if you still want to do it, maybe spot a market which is trading at lower valuation, take that contrarian bet. Maybe China, for instance, last year we gave that call. China was trading at less than 10 forward P.
Yep.
From there, it's up almost 30-40%.
Yeah.
Even today, amongst the top countries or top markets, China is still very cheap. It's below their long-term average in terms of forward P. So China kind of market can be a contrarian market. But again, it's very, very difficult. As you mentioned, you need to time it well. So for most investors, go for a strategic allocation, select a country like US or even maybe China for long-term allocation. These are 2 superpowers we already have. Go for SIP, simple 5 to 10% allocation. I think so you should be done.
Since we're on the subject, Nasser, I have to ask you as well. Let's talk about China and US, these 2 big markets, right? If someone has to make fresh exposure to international funds, would you look at international funds that are investing onwards into China right now and the US?
Absolutely. So, with specific question to your US and China, see, as far as US is concerned, US indices have rallied since the tariff war has gradually eased off, right, which we're currently in the middle of it. NASDAQ 6.13, S&P 500 4.9% are close to all-time high levels. Negative 6.13 and negative 4.9%. Staggered approach to a US equity is currently a more prudent strategy. I completely agree. An SIP or an STP does warrant at this kind of point of time. A strong positive is the US-China trade war de-escalating. So it's a very, very strong positive for both US. And as far as China is concerned, we have some very interesting themes which you usually don't get to capture otherwise. So there is energy transition, there's frontier China, but active alpha still exists. And this entire lithium space, I think, opportunities there if you have enough active fund of funds or some index, where we can index funds or passive routes which are available currently, those both can be explored between US and China. Our view, of course, is that currently, until things don't get more clear in terms of, the tariff war, which is kind of starting to de-escalate, Until then, we should still feel that there's a lot of opportunity in market neutral options available, which we can talk about as we go along.
Okay, fair enough. So let's now talk about the other aspect of this. In the Indian market, when you have decided that you want to invest in international funds, you have to then make the next choice. An active fund, one that's actively managed, where a human being is deciding what stocks will go in that fund, or a passive fund, which will only track an index. It could be any underlying index, like the S&P 500, like the Nasdaq, or many others. Nasser, I know you've done a lot of homework on sort of looking at the buckets and what is available in the market. So tell us, how many funds are there? How many are active? How many are passive? Where are the AUMs greater?
Okay, so before we get into that, so I think currently in the active space, between active and all the international funds that are available right now, we have 66. That's the last count that I have, Surbhi. And out of those, again, we need to check which ones are open currently for subscription for investors. I believe the Edelweiss are all open and available at the moment. But broadly, to answer your question on active versus passive, see, a passive fund basically tracks the index, or it's an FOF into an ETF. FOF is a fund of fund which is investing underlying into ETFs, and those basically track the S&P 500, for example, the Nasdaq 100 or the MSCI China, or other such indices. And 38 of the 66 of these international schemes are currently, which is about 57%, are passive, right? Those are US and China focused, and typically a broad market for holding low cost, no manager risk in a typical passive fund. Now, if you come down to the active fund of funds, we have roughly about 28 schemes, about 43% of these, where usually Indian fund by units often oversees the active fund. For example, JPM Global Equity, Schroders is another example, Global Innovation Fund, which tracks that particular fund. And most of these, again, they capture niche themes, which are not available in India for investors. And that's where we feel there are a lot of active alpha can still be generated on portfolios. So that's broadly it. Amongst the ones which are, by and large open, we have a fairly large list between passive and active. In passive, we have the Mirai asset, FANG, which is available. It's an ETF plus FOF. We have something on the passive side again, Motilal Oswal S&P 500, which is available. We have the ICICI Prudential Nasdaq 100 Index. In the active space, we have Invesco, India Invesco Global Consumer Trends, which is doing very, it's active and it's open at the moment. As I said to you, Edelweiss Europe Dynamic Equity Offshore Fund is there. Edelweiss US Tech Equity Fund of Fund is there. And then on the fixed income side, because that's again something which one can't ignore completely, we have DSP US Treasury, which is a fund of fund, and something which comes in from the Aditya Birla Sun Life Group as well, which is the US Treasury 3 to 10 year bond ETF fund of fund. So again, some of these between active, equity, passive equity, and then fixed income.
Okay, so lots of choices out there. But on the active-passive bit, Niranjan, I think this could be confounding for investors, right? You have, like Nasser said, you have 66 funds. Many are active, many are passive. So what should the approach be? I mean, because you're ultimately trusting maybe a foreign, not even an Indian fund manager, right. A foreign fund manager, probably don't know if, what is the underlying portfolio. So is it safer to just, dovetail on an index, or should you look at some active management as well?
So I think so, like in India, we also say midway is a better approach. Over here also, specifically if you're investing in US, probably a mix of active and passive makes sense. Go for a FOF active fund, underlying active fund, which has a long track record. Like we have a tie-up with JP Morgan. These funds have been in India for almost 10 years or even more than that, 15 years. Look for an active fund, FOF. Passive, you can definitely go for passive, but specifically if you're going for an ETF and buying it in India, it is very, very important to see whether the ETF is trading at a discount or at a premium. What has happened over the last couple of months, or in fact a year, that because the inflows have been stopped, many of these ETFs are trading at a huge premium. In some cases, the premium is as high as 20%. Now, mind you, even if market gives you zero returns and this premium comes down to zero, your return can be negative 20%. So if you're investing in passive, and unfortunately we don't have any index funds, most of these passives are via ETFs, and ETFs trade on Indian markets, Indian exchanges. They trade at a premium because the underlying is closed.
So you have to just buy in, sell the units of that
Only
ETF.
on the exchange.
So you're already paying a premium.
Already paying
to
a premium.
the underlying NAV.
The moment the underlying fund flows open up, this premium can come down. And we have seen premium hovering from 10% to 30%. So be very mindful if you're picking for a passive. My bet today would be go for a simple active FOF, which doesn't have this issue for retail investor. Go via SIPs and all and don't worry about all this.
Okay. Fair enough. We do have to take a very quick break on that note, but we'll come back on the other side to discuss the other important aspect, which is taxation. A lot of the international funds now enjoy better, favorable taxation compared to where we were historically. But still, how does that eat into your returns? What should be your return expectation? We'll discuss that on the other side.
Let's talk money